Welcome to the Deep Dive, where we crack open the most complex subjects and really give you the essential core of what you need to know. Today, we are diving deep into something fundamental for markets, for trust, really, financial reporting. Specifically, we're looking at the, let's say, murky world of misleading financial statements.
Yeah, and it's absolutely critical, this topic,
Yeah.
because financial statements, they're the literal lifeblood of trust and credibility in the market. They tell everyone whether a company's worth investing in or lending to or even partnering with. But, as our sources really hammer home, history is just riddled with these huge scandals, Enron, WorldCom, Lehman Brothers,
Yeah.
all stemming from deliberate distortions of the true financial picture.
Right. So our mission today for you listening is to give you that ultimate shortcut to getting informed on what feels like a continuous arms race. We're going to thoroughly unpack what really makes a statement misleading, how executives and sometimes accountants use this, fraudster's playbook, and crucially, how technology and regulation are evolving to try and fight back.
And before we jump into the tactics, it's probably good to clarify two terms. They sound similar, but legally they're distinct, mostly around intent. So we talk about misleading financial statements. That often means manipulation, maybe misrepresentation, with a kind of general intent to deceive stakeholders, or maybe just hide poor performance.
Okay, so that's misleading. And then there's the heavier charge, fraudulent financial statement.
Exactly. Fraudulent statements, that's a definite step further. It involves intentional misstatement or leaving stuff out, omissions of financial data. And it's specifically calculated to deceive people and, importantly, to induce reliance. They want you to act on that false information.
Act like buying their stock or giving them a loan.
Precisely. Buy their stock, give them that bank loan, extend credit based on numbers that just aren't real. And the stakes are just immense. We're talking about truly devastating effects, the destruction of major brands, unsettling entire sectors, destabilization that can ripple through global markets. And for the individuals involved, severe civil, legal, criminal consequences. We're talking years in prison.
Okay, let's unpack this a bit more. Our sources highlight something interesting that even really seasoned investors and analysts can get tripped up by this deception, often because they hold on to certain assumptions. So what are those initial aha moments, those pitfalls we need to get out of the way right now?
Right. The first big one, the major misconception, is this deeply ingrained belief that all audited statements are trustworthy. You see that audit opinion and it provides comfort, sure. But you got to remember, an audit is based on sampling. It's structured, yes, but it's still a sample. And sophisticated concealment, especially when it's coming from high-level management, the very people signing off on the representations, that can effectively bypass even rigorous external checks.
That's a serious vulnerability. So if the CEO is actively hiding something, the auditor is kind of reliant on their good faith, which might not be there.
So that's the crux of it, often.
Yeah, okay. Which leads to the second pitfall you mentioned, the jargon barrier. I'll admit, sometimes I assume if statements use incredibly complex, obscure language, it must be legit. Like they must know what they're doing.
And that's exactly the psychological shield fraudsters can use. That complexity can absolutely be intentional. It's used to obscure irregularities, sometimes outright lies, or just create ambiguity in how you interpret things. So when you see extreme complexity, don't just assume authenticity. You should probably assume it might be a cover, designed maybe to make you stop asking the hard questions.
Okay, point taken. Don't be intimidated by jargon. Now, I get the big obvious lies, but what about the small stuff? Like, I sometimes see what look like minor accounting errors or small adjustments buried in the footnotes. Is it okay to just ignore those?
You really shouldn't. Those minor errors, they're almost never truly inconsequential. They're actually critical warning signs. They can indicate deeper systemic problems with a company's internal controls, maybe their whole accounting system. It suggests the very controls needed to prevent large fraud might be missing or weak. Plus, small misstatements can add up. They accumulate over time and can lead to a huge cumulative impact on the results. So vigilance against the small stuff is key, because fraud is often a crime of opportunity, enabled by lax controls and, frankly, aggressive management pressure.
Okay, that sets the stage perfectly. Let's get into the mechanics then. If the goal is to make a company look better than it is, you either, boost the income or hide the debts. So that brings us to section 1, the fraudster's playbook. How exactly are the books cooked?
Right. Fundamentally, misleading statements involve manipulating those three core financial areas: revenues, expenses, and the balance sheet entries, all designed to present a picture that's more profitable, more viable, maybe less risky, than the reality. And we generally see this play out in, let's say, 4 primary, often interlocking techniques.
Okay, technique one is called creative accounting. It sounds almost benign, like clever bookkeeping, maybe not outright crime.
And it often starts exactly there. That's precisely why it's such a slippery slope. Creative accounting is really defined by exploiting the gray areas, the permissible discretion that exists within accounting standards like GAAP or IFRS. So technically, it might comply with the formal rules, the letter of the law, but it definitely violates the spirit of fair presentation.
So if a company has, say, 2 perfectly legal ways to account for inventory or maybe a lease, they just pick the one that temporarily makes the profit look better.
Precisely. It's basically financial engineering designed to put lipstick on a pig, as they say. It masks poor performance, minimizes how much risk you perceive, manipulates those key metrics analysts are always watching, and the implication is severe. It erodes investor trust, definitely. But crucially, creative accounting often precedes the much larger, outright fraudulent schemes. It kind of habituates management to bending the truth.
Right. It normalizes the deception. Okay, let's move to technique 2. Revenue recognition manipulation. Our sources are calling this the single most common type of financial statement fraud. And I'm guessing that's because the market just rewards growth above almost everything else.
That is absolutely correct. The primary goal here is inflating valuation by distorting growth, distorting performance metrics. Strong revenue growth just signals a healthy, growing company to the market. So the tactics here get varied, aggressive, and often quite complex.
Okay, start with the most basic one. Premature recognition.
Premature recognition is essentially recording revenue before the critical conditions for recognizing a sale have actually been met. So this could mean booking revenue before goods have actually been delivered, or maybe before a service has been fully rendered, or even before the sale is totally finalized and the customer has taken control of the asset. You're basically telling the market you completed a sale that's, well, still in the pipeline.
Okay, pushing it forward. The second tactic sounds more brazen. Fictitious revenue.
Oh, this is outright fabrication, pure invention. This is where you run into things like phantom sales, invoices generated for customers that don't even exist, or transactions that get counted twice. We saw this really clearly illustrated in that 2016 Wells Fargo scandal. Remember that? Employees, under just immense pressure to meet these impossible sales quotas, they fabricated millions of unauthorized accounts, credit cards, lines of credit.
Right, just making stuff up.
Exactly. And each fabricated account generated a tiny fictitious revenue gain, but multiply that by millions, and it created this false picture of aggressive cross-selling, of huge success across the whole bank.
Wow. That's not just hiding debt. That's actively creating a completely fake growth story.
It absolutely is. And then the third tactic here is manipulating timing differences. It's often called earnings smoothing. So instead of recognizing revenue fully in a really strong period, they might secretly understate it. They squirrel away the excess into some kind of reserve account. And then later, they pull from that reserve in a future, less robust period. This creates this false appearance of consistent, highly predictable growth, which analysts love, right? But it completely hides the actual volatility, the reliance on market conditions.
Okay, so if I can't boost my top line with fake sales or smooth things out, I guess the next option is to start messing with the costs on the bottom line. Which brings us to technique 3, expense manipulation and asset overstatement.
Right. This technique really leverages the judgment that's inherent in accounting, specifically around costs. The fundamental decision point is this cost an immediate expense? Does it hit the income statement today? Or can it be capitalized, treated as a long-term asset, and sort of spread out, amortized over many years?
And the fraudulent move is obviously to capitalize things that really should be expenses right now.
Exactly. When routine operating costs, think things like maintenance, advertising, general admin overhead, when those are inappropriately capitalized instead of being immediately expensed, it has this powerful dual effect. First, it dramatically boosts current net income because the expense just vanishes from the income statement for now. And second, it simultaneously overstates the value of the company's assets on the balance sheet.
The poster child for this has to be WorldCom, right?
Yeah.
What exactly was the mechanism they used?
Yeah. WorldCom's massive fraud involved capitalizing $3.8 billion with a B of line cost expenses. These were essentially their network usage fees, things that absolutely should have been reported as immediate operating costs. But they treated them like long-term investments, and the reason was pretty desperate. By 2000, WorldCom's growth was slowing down, and without this huge accounting trick, they would have had to report a net loss, which would have terrified the market. So the capitalization hid the lack of real growth, prevented that loss and led to this massive overstatement of assets and, well, eventually their bankruptcy.
And it's not always capitalization, right? We also see asset overstatement through just simple deliberate neglect.
Correct. Yeah. The neglect is often failing to apply the appropriate valuation adjustments or reserves. So this could involve overstating inventory by not setting up proper reserves for stuff that's getting old or obsolete, or just failing to write off impaired assets when they've clearly lost value. Look at waste management. Their executives strategically didn't write off the costs of abandoned landfill projects. They kept these useless assets on the balance sheet, hiding the negative financial impact. And that falsely boosted their profits by over, was it $1.7 billion over about 5 years?
Wow. Okay, that brings us to technique 4, which often sounds like the most complex and opaque one. Concealment of liabilities. Basically keeping the true level of debt a secret. This sounds like the realm of serious financial engineering.
It is pure financial engineering most of the time, and it's highly deceptive because it dramatically misrepresents the company's actual financial health. Stakeholders are led to believe the company is significantly less leveraged and therefore less risky than it truly is. The goal is always to structure obligations, whether it's debt, guarantees, maybe complex leases, so they're somehow excluded from the main balance sheet that everyone looks at.
How is that actually achieved in the real world? Like, what are the mechanics?
Well, the primary method, historically, has been the use of these complex non-consolidated entities, often called special purpose vehicles, SPVs, or special purpose entities, SPEs. Enron, of course, made these things infamous. They were structured very carefully so that Enron didn't have to consolidate the debt or the potential losses associated with those SPEs onto their own corporate balance sheet.
Wait, but if Enron controlled the entity, why didn't they have to consolidate it? That seems counterintuitive.
It came down to really technical compliance with accounting rules at the time, rules regarding ownership and control thresholds. Enron structured these SPEs so that just enough outside ownership was present, or the legal structure was just sufficiently convoluted, that it allowed them, under the rules, to keep billions in debt and really risky investments off their main books. This let Enron executives basically use the SPEs as giant dumping grounds for bad assets and massive debt, all while presenting this pristine, low-leverage balance sheet to investors.
And Lehman Brothers used something similar, maybe even more deceptive, right up until the 2008 crisis hit.
Yes, the infamous Repo 105 practice. This was incredibly high-level deception. It involved these short-term sale and repurchase repos. But Lehman would classify what were, economically speaking, just short-term loans secured by toxic assets. They'd classify them as actual sales right before the quarterly reporting date.
Hold on, if they had to buy them back just days later, how on earth is that a sale?
Economically, it absolutely wasn't. But they exploited a loophole in U.S. GAAP at the time. It allowed the transfer to be treated as a sale under very specific conditions. I think if the repurchase was due more than 90 days out and the asset value slightly exceeded the principal. So, by designating these short-term transactions as true sales, they temporarily moved tens of billions of dollars in highly toxic, illiquid assets off their balance sheet for just a few days, long enough for the official report to be filed, and then boom, the assets were brought right back onto the books immediately after the reporting window closed.
That really is accounting magic. For someone listening, what's maybe the simplest way to visualize that, moving debt off the books just temporarily?
Okay, think of it maybe like this. Imagine you owe $1,000, right? And the bank's coming to check your account balance on Tuesday. So on Monday night, you sell your car to a trusted friend for $1,000 with a contract saying you'll buy it back on Wednesday for slightly more. You use that cash to pay off the loan Monday night. The bank checks your perfect zero balance on Tuesday. Looks great. Then, immediately after the bank leaves, Wednesday morning, you buy your car back from your friend using new borrowing, and the debt just reappears on your personal ledger. Lehman was doing this effectively, with tens of billions in mortgage-backed securities every single quarter. It was pure window dressing, just to mislead stakeholders about their true debt burden and risk level.
Okay, wow. Window dressing on a massive scale. Our fifth technique, then, is arguably the simplest but maybe the most easily overlooked: improper or inadequate disclosures.
Yeah, this is about intentional omission or maybe misrepresentation of crucial information, often hidden away in those dense footnotes, or maybe the management discussion and analysis section, the MD&A. The truth might technically be present somewhere in the hundreds of pages, but it's obscured, it's deliberately vague, or just buried deep in complex legal prose. They often fail to properly disclose things like significant contingent liabilities, complex contracts, or really critically related party transactions, RPTs.
Why are related party transactions always such a huge red flag?
Because think about it. If a company enters into a major contract or some financial arrangement with another entity that's owned or controlled by an insider, maybe a family member of the CEO, a key executive, a close friend, the terms of that deal are almost certainly not at arm's length, not fair market value. It could easily be used to siphon funds out of the company, transfer bad assets off the books, or even boost fraudulent revenue through non-economic transactions. Full, clear disclosure of RPTs is absolutely mandatory because they show a clear potential pathway for executive self-enrichment or serious manipulation. When those are hidden or obscured, it signals a massive potential issue.
So the playbook is clear: inflate the good stuff, shrink or hide the bad stuff. But how do we or regulators actually find this before the whole company collapses? That brings us nicely to Section 2, identifying the red flags.
Right, the key realization here is that fraud rarely happens in a vacuum. It almost always leaves a footprint, some kind of trail. So we look for indicators across four distinct categories: financial, behavioral, organizational, and sort of broader business context signs.
Okay, let's start with the hard data. Category 1, the financial warning signs. What are the anomalies in the numbers that jump out immediately to, say, a forensic accountant?
The absolute number one, the most common indicator of financial statement fraud is that growing gap. Rising revenue and reported net income without corresponding growth in actual operating cash flow. If a company is reporting massive profits on paper, but the bank account isn't actually filling up at a similar rate, that fundamental disconnect strongly suggests the revenue might be fictitious, or maybe it's tied up in really aggressive accounts receivable that haven't actually collected any real money yet.
That seems like such a solid metric. Cash is cash, right? You can't fake the bank balance easily.
Exactly. Fictitious revenue eventually hits that wall, the cash flow wall. Other signs include growth that's just totally inconsistent with industry trends. If all your competitors are reporting stagnation or decline, but your company maintains consistent, robust, double-digit growth year after year, that demands serious scrutiny. Also, watch for suspicious spikes in performance, particularly in the final reporting quarter of the year, sometimes called the Big Bath Quarter, where management realizes they need one last desperate push to hit that annual target, and of course, frequent unexplained restatements of prior financial results. That just suggests the numbers weren't reliable in the first place.
Okay, so the numbers don't look right. But then there's the human element, category 2, which is often the underlying motive, right? Behavioral warning signs.
Yeah, the human element is absolutely crucial. The Association of Certified Fraud Examiners, the ACFE, consistently reports that the vast majority of fraudsters display at least one behavioral red flag while they're committing their crimes. The primary motivators, often pressure from personal financial difficulties or maybe just management living significantly beyond their apparent means, creating this urgent need for cash that drives the fraud.
What about their behavior specifically at work?
Right, this is often more subtle. It's related to maintaining control and hiding their actions. Look for extreme control issues. Management that's unwilling to share key financial duties. A really major red flag, often cited in big cases, is the executive who refuses to take vacation time. Seriously. They're terrified that if they step away, even for a week, their temporary replacement might access the system and stumble upon the complex, fraudulent scheme they're running. Beyond that, watch for dishonest, maybe hostile or aggressive attitudes, particularly when auditors or even subordinates start asking critical questions about the numbers or the processes.
Okay, moving to category 3, organizational warning signs. What are the structural flaws within a company that might enable fraud to take root and just continue?
Well, fraud definitely thrives in environments with weak internal governance. So look for things like high turnover in key accounting or finance positions, or sudden, maybe unexplained changes in external auditors, especially if it looks like the company might be opinion shopping, trying to find an auditor who'll be less skeptical. Structural flaws also include environments where operating and financial decisions are just dominated by a single person or maybe a very small, insular group, particularly if they discourage internal dissent or lack meaningful independent oversight from the board.
And that focus on hitting targets you mentioned earlier sounds like a huge driver here, too.
Oh, it's a critical organizational warning sign. This undue, almost desperate emphasis on meeting highly quantitative short-term earnings targets, especially when those targets are directly tied to massive executive bonuses, it creates this really perverse incentive structure. If the only way you get that huge bonus is to hit an almost unachievable number, well, management is effectively incentivized to find potentially illegal means to meet that target. And additionally, you have to scrutinize the board of directors. Boards that are full of insiders rather than truly independent members with financial expertise are much more likely to let this kind of fraud continue unchallenged.
Okay, finally, category 4, business warning signs. This seems to look at the company's reality versus its industry context.
Yeah, exactly. We're looking for fundamental disconnects with the market or peers. Are their profitability levels or operating margins dramatically out of line with their direct competitors or industry norms? If everyone else in the sector is making, say, a 5% margin, and this one company is consistently reporting 15%, you absolutely have to find out why. It could be innovation or it could be fraud. Also, be wary of operating results that are highly sensitive to external economic factors, like sudden shifts in interest rates or inflation, especially when combined with aggressive accounting practices. That combination can signal instability being covered up by accounting artifice.
Okay, that's a lot of signs to watch for. It sounds incredibly tedious to track all that. If you had to pick just one analysis, what tool gives maybe the fastest, most reliable red flag once a suspicion is raised?
Mm. The fastest single flag will probably come from comparative ratio analysis, but honestly, to really understand the context, you need the other two analytical tools as well. Auditors, analysts, they rely heavily on comparative analysis to investigate the relationships among the financial numbers themselves.
Okay, let's quickly touch on them. Start with vertical analysis. What does that actually do?
Vertical analysis basically simplifies the income statement for comparison. It examines each line item, like cost of goods sold or selling general and admin expenses, as percentage of total revenue, but within a single reporting period. This helps spot inconsistencies in those proportional relationships year over year or quarter over quarter. For example, if historically cost of goods sold was always around 50% of revenue, and then suddenly in one quarter it drops to 30%, that signals a massive unexplained change in profit margin. Could be efficiency, sure, but it could also mean inventory costs are being manipulated or sales are being overstated relative to costs.
Got it. Then horizontal analysis takes that comparison across time, right?
Precisely. Horizontal analysis compares performance by looking at the percentage change in individual line items, but over several periods, usually year over year or sequential quarters. This helps reveal unnatural velocity or trends. So, if revenue is growing at a steady, healthy 5% every year, but suddenly accounts receivable leaps 40% in one period, well, those two numbers should generally move somewhat in proportion. That kind of disconnect suggests maybe aggressive extension of credit, difficulty collecting actual cash, or potentially that premature revenue recognition we talked about.
Okay, and finally, comparative ratio analysis. You said this might be the fastest flag.
It often is, because it measures the relationship between two different accounts, things like sales versus cost of goods sold, or maybe total assets versus total liabilities. You calculate these key ratios and then compare them to the company's own historical norms or to industry peers. A sudden, unexpected shift in a key ratio, like a major, unexplained increase in the assets to liabilities ratio that might signal that liabilities have been artificially hidden using techniques like Repo 105 or those off-balance sheet SPVs we discussed. That warrants a much deeper dive, a highly detailed examination.
Okay, it's clear that detection is still a deeply analytical, somewhat manual process, even with these tools. Let's move to Section 3. The regulatory guardrails that were put in place, especially after those massive scandals in the early 2000s were exposed. We all know the Sarbanes-Oxley Act, SOX, from 2002 was the major legislative response to Enron and WorldCom.
Oh, SOX was a monumental shift. It fundamentally changed corporate accountability, particularly in the U.S. Because before 2002, it was frankly far too easy for senior executives to just claim ignorance, right? To say, oh, the accounting details were handled by lower-level staff I didn't know. SOX really put the responsibility squarely at the top.
And the centerpiece of that is Section 302, personal accountability.
Yes, Section 302 mandates that the CEO and the CFO must personally review and certify the accuracy and completeness of the financial statements. They do this quarterly and annually under penalty of law. This certification is absolutely critical because it binds the executive's personal freedom and their wealth directly to the integrity of that financial report. Willful false certification can lead to millions of dollars in fines, mandated repayment of any incentive-based compensation they received during the fraud period, those are called clawbacks, and actual criminal jail time. Suddenly, the personal cost of signing off on a fraudulent document became terrifyingly high.
Right, so the buck really does stop there now, legally speaking. SOX also addressed those systemic issues we mentioned earlier, the weak internal processes through Section 404, right?
That's right. Section 404 requires both management and the external auditors to formally assess and report publicly on the effectiveness of the company's internal controls over financial reporting. This forced companies to rigorously document, test, and maintain structured systems, clear audit trails across basically every financial process. It essentially created a much stronger framework that makes large-scale concealment far harder to pull off without leaving tracks.
It also tackled those conflicts of interest we saw, like with Arthur Andersen acting as both consultant and auditor for the same companies.
Absolutely. SOX enforced much stricter auditor independence rules. It mandated restrictions on the non-audit services like internal consulting or system design that external auditors could sell to their audit clients. The idea was to remove the financial incentive to maybe look the other way on the audit side. It also required the mandatory rotation of the lead audit partners every few years to prevent those overly cozy long-term relationships that might compromise professional skepticism and independence over time. And furthermore, it established the Public Company Accounting Oversight Board, the PCAOB, a new body to set auditing standards and provide independent government oversight of public company audits for the first time.
Okay, so we have personal liability, stronger internal controls, more auditor independence. But if executives still decide to collude, does a simple signature really stop fraud? Or does it just change how they try to commit the crime? Because despite all these guardrails, we still see auditors miss massive fraud sometimes.
And that's the persistent challenge, isn't it? Auditors are responsible for achieving reasonable assurance, not absolute assurance, that the financial statements are free of material misstatements. And the entire profession is grounded in maintaining professional skepticism. But there are inherent limitations that lead to what we call the persistent expectation gap, which is the gap between what the public thinks auditors do guarantee no fraud and what they actually can do.
Exactly. The public often mistakenly assumes a 100% guarantee against any fraud, no matter how small or well hidden. But auditors rely on sampling techniques. They simply cannot check every single transaction. They rely heavily on management representations and documentation, which, as we've discussed, can be deliberately inaccurate or incomplete. They also operate under strict time and budget constraints. But honestly, the greatest limitation is intentional, high-level concealment and collusion. Traditional, structured audit procedures are often totally ineffective against senior management actively working together to hide or even destroy evidence. Okay, let's try quantify the damage, because the consequences are really essential to understanding the gravity of this kind of deception.
Yeah, the numbers are stark. Financial statement fraud is consistently documented by groups like the ACFE as the costliest type of occupational fraud. Its median loss is significantly higher than, say, simple asset misappropriation like expense report fraud.
Yeah.
The median loss is often cited around $766,000 per instance. But honestly, that number pales in comparison to the total market damage when a large public company fraud is revealed.
Let's quickly review some of those big case studies again, just in terms of cost.
Right, look at the sheer scale of the systemic damage. Enron's collapse, driven largely by those SPEs hiding, $25 billion in debt, it led to an estimated $74 billion in investor losses.
Wow.
And critically, it resulted in the dissolution of its auditor, Arthur Andersen, literally eliminating one of the big five global accounting firms. The consequences were industry-wide. Waste Management, when they eventually restated $1.7 billion in profits, their stock price collapsed, costing shareholders over $6 billion. And it led to massive fines for Andersen as well, contributing to their demise.
And then we had cases where the goal wasn't just boosting stock price, but pure executive theft covered up by the accounting fraud.
The Tyco International scandal is a perfect example of just brazen theft and cover-up. The CEO, Dennis Kozlowski, and the CFO, Mark Schwartz, they stole over $600 million directly from the company. And they manipulated earnings partly to cover up their extraordinary unauthorized executive compensation and frankly lavish personal spending sprees, remember? The $6,000 shower curtain. They both ended up serving significant time in prison. And even in smaller cases, the market consequences are almost unavoidable. Stock price collapse, potential delisting from exchanges, major difficulty raising capital later because your cost of capital skyrockets, and just the total erosion of trust with suppliers, customers, partners. The cost of complacency or getting caught is truly devastating.
Okay, so given that detection is so hard and the consequences are so incredibly high, prevention has got to be paramount, right? That brings us to our final and maybe most forward-looking section, prevention and the technological arms race.
Absolutely, prevention is the foundation. Because early detection, or ideally prevention, dramatically minimizes the eventual losses. And the single most important preventative step one that's often overlooked, especially by newer or smaller businesses, is strengthening those internal controls, particularly implementing robust segregation of duties.
Walk us through what segregation of duties actually means in practice, like day to day.
Okay, basically, it means structuring your systems and processes so that no single employee has end-to-end authorization to initiate, record, authorize, and reconcile a transaction. So the person who authorizes an expenditure shouldn't be the same person who records the transaction in the books, and neither of them should be the person who reconciles the bank statement at the end of the month. By dividing responsibility for key functions like bookkeeping, depositing funds, reporting, and auditing, you significantly reduce the opportunity for an individual fraudster to both create and conceal a fraudulent scheme without somebody else noticing.
Makes sense. We also need to talk about the corporate culture aspect, that phrase tune at the top.
Oh, that's essential. Ethical leadership has to actively model and enforce transparency and accountability from the very top down. Numerous studies, including those by the ACFE, show that a poor ethical culture where maybe leadership is seen cutting corners or being overly aggressive is often cited as a root cause or at least an enabler of inaccurate reporting. It allows subordinates to rationalize their own fraudulent behavior. And we also need to look at correcting those incentive structures we talked about earlier, avoiding tying management bonuses solely to those hyper-aggressive short-term earnings goals, which just incentivizes finding illegal ways to meet the targets.
But even with the best controls, the best culture, people still slip up or are determined to commit fraud. So how are most existing frauds actually caught in the real world?
By a landslide, and this is a remarkably consistent finding in fraud studies globally, the number one way fraud is detected is through tips. Tips from employees, sometimes vendors, occasionally customers. This makes empowering potential whistleblowers absolutely critical. Companies need to establish secure, truly anonymous reporting channels like hotlines or online portals, often protected under SOX regulations, to give employees a safe mechanism to report concerns without fear of retaliation.
Okay, let's pivot now to the digital advantage. Technology, it seems, enables new kinds of fraud, but it also provides some pretty revolutionary tools to fight it.
It's definitely a continuous evolving arms race. Historically, anti-fraud efforts relied heavily on traditional rules-based systems. These systems are pretty rigid. They look for transactions that violate predefined rules, like flag any purchase over a certain dollar amount or from a specific vendor. The problem is, fraudsters quickly learn how to game these static rules. They structure transactions just below the threshold, for example.
Right, so the game changes entirely with things like artificial intelligence and machine learning, AI, and ML.
Dramatically. AI and ML represent a massive step forward because they are adaptive, they learn. They can analyze immense volumes of financial records data, far too vast for humans to manually process, and they can spot subtle anomalies, outliers, unusual patterns much faster and often more accurately. Crucially, ML algorithms learn from past examples of both fraudulent and non-fraudulent activities. This allows them to recognize complex, evolving patterns, making them potentially effective against brand new, previously unseen fraud schemes as they emerge without needing a predefined rule.
And where this technology really seems to shine is dealing with all that messy, unstructured data, which is often where the sophisticated fraudsters try to hide their tracks, right, in the text.
That's natural language processing, or NLP. And yes, it's huge. Estimates vary. But something like 80% or more of corporate data today is unstructured. It's everything that isn't in a neat spreadsheet column.
Yeah.
The text in footnotes, the narratives in the MD&A, the clauses in contracts, internal emails, even meeting transcripts. NLP algorithms are becoming essential for wading through that mountain of textual data, which is precisely where crucial disclosures or intentional obscurities are typically buried.
Okay, how is NLP used by, say, forensic teams in a practical sense? What can it actually do?
Well, it has several really fascinating applications already. First, there's sentiment analysis. NLP can analyze text to detect the underlying tone, positive, negative, neutral, uncertain, so it can flag discrepancies. For instance, if the CEO's letter in the annual report is overwhelmingly positive, but the language used in the detailed footnotes uses weak verbs, cautious qualifiers, or hedging language like "we anticipate" could potentially impact, that mismatch in sentiment raises a red flag. Second, keyword analysis is vital. NLP can scan documents for the frequency and context of terms commonly used to obscure issues or downplay problems. Think words like unusual, non-recurring, or the really famous one, one-time charges.
Why is one-time charge so suspicious? Doesn't every company have those sometimes?
They do, occasionally. But if a company constantly takes significant one-time charges year after year, quarter after quarter, well then they're effectively normalizing costs that really should be classified as recurring operational expenses. NLP can quickly spot this pattern of repetition across multiple reports, signaling potential manipulation intended to boost reported core earnings by excluding these supposedly non-recurring items.
Okay, interesting. And the technology can even analyze like communication patterns between people.
Yes. In more advanced applications, NLP can analyze vast quantities of digital communication emails, internal chat logs. For internal fraud investigations, it could potentially identify key executives who communicate very frequently despite having no direct formal reporting structure between them, possibly signaling collusion or informal influence networks. It could also be used, controversially sometimes, to analyze customer contact center audio files or even internal meeting transcripts, looking for linguistic cues, maybe patterns of high stress in voices, to determine if, say, sales agents are unduly pressuring customers, a sign of potential channel stuffing, or if management is exhibiting hostile or deceptive behavior when discussing financial results internally.
Wow, that level of scrutiny is pretty intense. But using this kind of powerful technology isn't without risk, is it? You can't just flip an AI switch and expect perfection.
Absolutely not. The technological fight against fraud is highly dependent on careful implementation and quality control. There are several major risks. First, there's the risk of over-reliance. Analysts or auditors might place too much trust in the algorithm's output, leading to a false sense of security and maybe overriding their own crucial human judgment and professional skepticism. Second, the risk of false positives. The algorithm might flag legitimate, unusual, but okay activities as potentially fraudulent. This leads to unnecessary, costly investigations that drain resources and time. Third, and this is critical for ML, these models require huge quantities of high-quality training data to learn effectively.
Which means if the historical data you use to train the system already contains some undiscovered, sophisticated fraud, the model might actually learn to ignore it, thinking it's normal.
Exactly. That's a huge data integrity risk. And that leads to the fourth risk, the dependency on ongoing data quality. If the raw data flowing into the system day to day is poor, inconsistent, maybe even intentionally manipulated before it gets analyzed by the AI, then the models will inevitably fail to accurately identify the fraudulent activity. Technology is an incredibly powerful tool, yes, but it's definitely not a replacement for vigilant human oversight and critical thinking.
This has been an incredibly detailed deep dive. Let's try and synthesize the absolute core knowledge for our listener before we close out.
Okay, the three key elements to really take away are probably these. First, financial statement fraud fundamentally involves the systematic manipulation of revenues, expenses, liabilities, and assets. You need to look for those common techniques we discussed. Things like premature revenue recognition, improper capitalization of routine expenses, and think of the WorldCom, and the concealment of debt using those off-balance sheet vehicles like SPVs or Repo 105.
Okay. And second, the single biggest, most reliable signal that fraud might be occurring is usually that disconnect. High reported profits that just don't translate into actual growth in operating cash flow. The money isn't really materializing in the bank account.
Right. And third, remember that regulatory frameworks like Sarbanes-Oxley fundamentally shifted the landscape by enforcing personal accountability. Requiring CEOs and CFOs to personally certify the accuracy of their company's reports under penalty of law was huge. Ultimately, market integrity depends on that collective commitment to transparency from management, auditors, regulators, and importantly, investors like you.
Okay, now here's where it gets really interesting as we look ahead, building on that idea of an arms race. The battle for honest financial reporting, it really is this continuous, evolving struggle between transparency and deception. And while we just talked about AI as a powerful defense mechanism, the
Yeah.
current business environment is actually creating a brand new set of vulnerabilities using AI itself.
That is exactly right. The extreme pressure on companies today, especially tech companies, to demonstrate constant innovation and explosive growth, particularly in these hot emerging fields like AI, quantum computing, biotech, it's already generating new waves of securities litigation. We're now seeing this clear trend of what people are calling AI washing, essentially companies overstating their actual AI capabilities, maybe their R&D success, their future revenue prospects based on AI, or even the strength of their AI-related partnerships, all to mislead investors and pump up their valuation.
Huh. So this is kind of the modern version of the dot-com bubble's aggressive revenue recognition problems, just applied to technology hype. An aggressive prospectus that wildly overstates AI capabilities in its MD&A, for instance, might look amazing today. But that cash flow statement, maybe 2 or 3 years down the line, that's what will tell the real truth about whether that hype technology actually generated any meaningful revenue. This emerging type of securities litigation really proves that the tools and the specific motives might change, but that core temptation to deceive stakeholders about future prospects, it remains constant. So the question for you listening is, which hyped companies out there today might be over-promising on their current technological capabilities? And what will their cash flow statements look like when reality eventually catches up?
Definitely something to keep in mind the next time you look at a high-flying growth stock's valuation relative to its actual free cash flow generation.
We'll see you next time on The Deep Dive.